The top 10 money myths that block your financial freedom. This is actually one of my favorite topics. In fact, I find this to be kind of fun. What I find is that most things that most people believe about finance are just not true or not optimal. And that's why my blog is Unconventional Wisdom. It's about all the things I've learned over the years based on experience and research and reading hundreds of books. But it's things that I've learned that actually work. And it's amazing how often the things that most people believe are not true and hold you back. So there are lots and lots of these money myths. However, I tried to put together the 10 most common ones that I find actually hold people back from achieving what they want in their life. So here's let's go through them. So first of all, here's what they are, and then I'll explain each one of them. The first one is that wealthy people have nice cars, homes, and vacations. You probably think they do, right? The economy helps you predict the stock market. Risk is your investments going down. Your risk tolerance is part of who you are. You are smart money. I'm not trying to be insulting there, but it's a lot of people think that. So it's an important thing. Asset allocation is effective investing. You can reduce your risk and volatility without reducing your returns. Stock market returns are random. Crypto or day trading is effective investing. Real estate returns are as high as stocks. So those are the 10 most common. So let's sort of take them each one by one. So the first one, wealthy people have nice homes, vacations, and cars. Now, interestingly, there's kind of a stereotype of, for young people, the hot girl that goes after the guy with a great car. And the thinking is that those people have money, but you know what? I've seen their finances. I've seen the full finances of thousands of people, and I can tell you that the guy with the expensive car is no more likely to have money than the person with an older used car. It's no more likely at all. So wealth, money, is a sign of net worth. Okay, not income. So a nice car is usually just a sign that someone spends a lot of money, right? So a car doesn't go up in value, so people are kind of spenders. So now it could be they're spenders because they make a ton of money, because they have a ton of money, but very often it's because they spend it, but they don't actually keep it. Remember, it's what you make, or what you keep, not what you make, that really matters. So now there's an excellent book there called The Millionaire Next Door, a real classic, that is about this topic, and it actually showed that most millionaires are very frugal, and that's why they are millionaires. They've always not spent too much and invested wisely and build it up, and that's how most people get rich. Now, of course, there's a few billionaires that start up companies, and there's a few big noteworthy exceptions. But the vast majority of millionaires are regular, everyday people. They live in an ordinary neighborhood. They have a regular house. They drive an ordinary car. In fact, most of the people that know them have no idea they're millionaires or even multimillionaires. They just live like regular people. And you know what? So I've seen so many people, and then seen their finances and met them, and when I'm at a party, I can basically tell who has money and who has not. And so it's usually the people that are flashy, that appear to have money, that are not. Those are usually the spenders. So all right, but the people that have money, often what you see about them is kind of a quiet confidence. They're not worried about money, but they don't flash it. And part of it is, if you have a lot of money, you don't want to have people like you just because you have money. So you want to find real friends. So often these millionaire next door are they're not flashy about their money at all. In fact, they're quite understated about it. So in fact, there's a classic story in this book about the guy who had a $200,000 red sports car, and he kept it in a garage 20 miles from his house. And about once a month, he'd go over there and drive it for a bit. Nobody knew he had this car, and that's kind of a typical thing of a lot of wealthy people tend to be understated in this way. Number two, the economy helps you predict the stock market. All right. So, interesting is I've been to tons of investment presentations, all these investment firms, and the vast majority of them start out with, this is what we think is happening in the economy, therefore, this is how we're investing. So you know what? That makes no sense. And so, you know what, like, so we're always looking for, all-star fund managers that are really exceptional fund managers. What I find is when people have an investment presentation of that type, it's a sign they're probably not an all-star fund manager. They're probably just doing the regular stuff, trying to get people to buy their fund, but they're not, but it's actually not logical to do that. So, and it takes a little bit to understanding, because when we watch the business news, all they talk about is the economy and how it affects the stock market, right? So, but see, the truth is the stock market is always predicting the economy 6 to 12 months into the future. It's not the other way around. So anybody who's investing is thinking, I'm going to buy the stock based on what I know and what I expect already happened. So the current prices of all the stocks are based on what the people that bought those stocks think that they're worth down the road, based on all the knowledge all about the economy and the companies and everything that's happening. So that's already built into the prices. Okay, so the stock market prices include the consensus of opinions on what the economy will do. So the classic line is Peter Lynch. Actually, I thought Warren Buffett said this, but it's Peter Lynch who said, I've always said if you spend 13 minutes a year on the economics, you've wasted 10 minutes. And it's really true. I find a lot of the top investors don't really look at the economy much at all. They want to make sure that their companies are solid and growing and well managed and all that. So now, just to prove that this is actually true, so I graphed so the economy is best shown by the GDP, and the stock market. I took the Canadian stock market here. So we're taking the Canadian stock market and the Canadian GDP. And you see when you graph them, first of all, you notice the stock market moves way more than GDP. Like it's scribbling looks like a big scribble over, and the GDP is relatively steady. Okay. Now, when you do the actual correlation, so the actual correlation is 15%. So you'd think it would be much higher, but it's 15%. And really, I've seen over time, sometimes it goes a bit negative. I've run this various times. So it's usually, quite a low number. Now, you'd think that the real correlation would be the stock market compared to the GDP the next year, right? Because remember, the stock market's always trying to predict a year later. But that correlation is 23%. So it's a bit more. There is some correlation between the stock market now and GDP next year. So, but not that much. And actually, so when you think about it, it's you got to think of it this way. So it's the when you say, you're looking at the economy, things look really good. Fund managers will say, therefore, I'm going to invest aggressively. What they should really be saying, things look good in this economy. That's why the stock market went up last year. That's the real logic of it. So now you think, okay, that's short term, but long term, it makes sense to do that, right? So now this is from a real classic book called Triumph of the Optimist. It shows the 16 most developed countries in the world and their stock market. And so this chart here, of their GDP after inflation and their stock market growth after inflation. And when you see the chart, you realize there's actually a slight negative to it. So the actual correlation is negative 0.27%. So it's almost zero, right? But it's a negative. It's a negative correlation. Now, I don't think the negative is actually that you should take that the economy doesn't matter. So there really isn't any correlation. Countries with a faster growing economies had slightly slower growing markets. But from looking at individually, I think most of it is from quirks, countries that lost wars and things like that. It's not really from the GDP. But, say this is a 100-year chart from 1900 to 2000. And there's just really no correlation that, one country can have a significantly faster growing economy for 100 years, and the other country still has a better stock market. That's really the norm. There's not really any correlation with them at all. So now, to understand that the reason that this happens is so the stock market is businesses, right? You're investing in big businesses that are growing over time, and you're investing in companies. The economy is mainly consumers, so it's 70% consumer spending, 15% government spending, and only 15% business investment. So many things are in the economy. Like 85% of the economy is not businesses. And the profits of a business are affected by all kinds of things other than the economy: competition, taxes, available labor, new products, technology, cost cutting, regulations, suppliers. All those things, in addition to the economy, are all what affect the business. So economy is only one of a whole long list of things, and that's why you don't really see much correlation there at all. So, okay, but the one important thing is to remember is that if there is a correlation, it's the stock market is the head, the economy is the tail, not the other way around. You can't tell where the head is going by studying the tail. All right, myth number 3. Risk is your investments going down. Now, that's what most people think, right? Oh, my investments go down. I'm trying to avoid having my investments go down. But, in reality, volatility is, we just call that volatility. It's prices going up and down. It's not really risk if it just comes back. It goes down a bit, it comes back. That's not really risk, because you didn't actually lose anything if you stayed in, right? So one way to look at it, so risk is often measured by statistics like beta and standard deviation. And so, if a stock falls, often what actually happens is you'll see the risk ratings on it are higher because it's fallen, because it's a bit more volatile. But it's actually not riskier. The same stock falls, it's actually not riskier than it was when it was higher. In fact, it's probably safer because it's lower. So that alone doesn't actually tell you anything. So now Warren Buffett has all kinds of insights in here. And, he has his most common rules, which are quoted a lot, but they're almost always misquoted. They're misunderstood. So Warren Buffett's 2 rules, you probably heard them. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Okay, so you think maybe that's what he's saying, don't lose money. However, he's 100%, he's always been 100% in stocks. His stocks go up and down every day. So why would he invest this way if he's saying don't lose money? So now what he really means is long term. So Warren Buffett's process is to buy $1 for 50 cents, buying undervalued companies, and it's great companies that are going to grow long term. So what he means by don't lose money is if you buy a really solid, well-run company at a good price and it's growing over time, you're highly likely not to lose money over the long term. So he's not talking about it, you get these short-term fluctuations. He's talking about losing money over the long term. And that's the real definition of risk, losing money over the long term. So now we see that also in financial planning. So, we help clients set and achieve their life goals. You try to retire down on the road. And so risk for you then is the risk that you don't achieve your life goal. So if you have a financial plan, let's say that in the financial plan, you have 8% or 6 or whatever you have, 8% rate of return is what you have in your financial plan. And that's to live the life that you want. So then risk for you, from a financial planning perspective, risk is that your long-term return is less than 8% a year. Now, the reason this is important because most people think when you're looking at reducing risk, you should have more bonds and more cash and less stocks, so like less volatile. But if you're going to average 8% a year as a long-term investment, you can't really have stocks or bonds, bonds and cash, or you have to have a very low amount because those are really going to drag down your return. Those are almost for sure aren't going to make 8% as a long-term rate of return. So it's when you're thinking this way, it's actually the more stocks you have, good quality stock investments, the higher your chance of getting a long-term return of 8%. So that's how you have to think of risk. So now Warren Buffett's other quote, which is great, is risk comes from not knowing what you're doing. I think that makes a lot of sense. So I think a lot of people diversify as a defense against not knowing what they're doing, but he always believes that don't even diversify too much because if you have really great stocks. So now, I have a picture here that I just want you to kind of get this is kind of a concept. These numbers aren't actual, but if you look at stocks, they go up and down a fair amount, but over time they're trending up. While if you take stocks, bonds and cash, they tend to fluctuate a lot less, but after inflation, often they're being dragged down very slowly. And so what do you call risk? Something that fluctuates a lot, but it's way up 20 years later, or something that doesn't fluctuate much, but years later is down slightly from in purchasing power after inflation. So to me, that's what the real risk is. It's the long-term losing money. It's not the short-term decline of your money. Okay, myth number 4, your risk tolerance is part of who you are. Now, when you go to a bank or a financial advisor, one of the first things they bring out is a risk tolerance questionnaire, and you fill it out, and they say, that's what you are. You're a moderate investor, and that's how you should invest. And it's kind of as if that's how you always are, and you should always invest this way. And there's a big problem with it because it's not who you are. It's how you were on that day, how you felt, but also risk tolerance is a learned skill. You can learn to become have a higher risk tolerance over time. So in fact, a lot of investors that are really conservative, I find, in fact, for example, often a lot of couples we see, it's the woman that's more conservative, but it's often because she's just less interested in investment, less knowledgeable, right? So low knowledge can be a reason why you don't have much risk tolerance, because you don't really understand how the stock market grows long term. You don't really understand how it works, and therefore you've got exaggerated beliefs of how much you could lose, because you hear these stories of people losing lots of money. So you tend to, with low knowledge, you tend to think it's riskier than it actually is. So I like to tell the story of the first time I ever flew on a plane. I was just terrified, and I call this turbulence tolerance, right? So I was terrified every time the plane would fluctuate a bit. I was grabbing onto my arm rests, and oh my god, I felt really quite scared. Anytime there was a bit of turbulence. And now I've flown many times. You kind of realize, this turbulence, it just happens, and you just keep going. And the worst possible thing you could do if you are scared in turbulence is get out of the plane, right? It was the same thing with your investments. You buy investments and they get turbulent. The worst thing you can do is get out at that point in time, right? So once you're in it, you go to the end and get to your destination, right? So airplane turbulence, you get used to it with experience. And the same thing happens with the stock market. And it's a highly valuable skill. If you can invest for more risk tolerance, you can make 2 or 3% a year or more as a higher rate of return over the long term. And over a few decades, that's absolutely massive. It's the difference between retiring comfortably and not. So having a higher risk tolerance is one of the most important life skills if you want to be able to retire comfortably. So, right. So what gives it to you is experience, especially in bear markets. Once you've been through a big bear market, a big market decline, and come out the other side, then you're much more experienced. And it's also education. I've got I've just been reading this book, Stocks for the Long Run by Jeremy Siegel. I've read actually all his previous books. Single best investing book out there. So, and it's just by reading and learning about it that you can gain a higher risk tolerance. So, and that's something that we actually do, is we spend time with our clients, helping them to learn a higher risk tolerance, so that you can't invest beyond what you're comfortable with. However, you could learn to be comfortable with more volatility, and because that's what actually works for you long term. So it's that taking that extra care to do that is one of the most valuable things. And it's, if your advisor just says, oh, you're moderate and that's it, they've kind of condemned you to getting a low return for your life, and they're not spending the time to help you learn. So risk tolerance is a learned skill, and really what it is, what really is risk tolerance? Really what it is, it's the ability to do nothing when your investments go down. That's really all risk tolerance is. You do nothing when it goes down, and you get decent investments over time. A year or two later, it's fully recovered and it continues growing. And so just by doing nothing, that's how you survive the decline. So part of education, I've shown a few charts a bunch of times on various videos that I've done, but we've got the long term, the 200-year chart by Jeremy Siegel, showing stocks and bonds and cash returns after inflation. And you see the stocks as a long-term steady. It's a very steady line, and it's actually always very close to the trend line. Now, in the chart that in his book, it's an exponential graph, and so it's drawn much smoother than you experience it. But But in reality, the stock market, when you take decades of time, it's almost always very close to the long-term trend line, which is around 7% above inflation. That's about the long-term return of stocks. So, and the last 200 years, it's always been close to that long-term trend line. So, and bonds, on the other hand, you get like 40-year periods where they go down and 40-year periods where they go up based on so interest rates went up and inflation went up from 1940 to 80, and bonds kind of got killed for 40 years. I call it the bond collapse. And then from 1982 to 2021, interest rates went from 20% down to 1%, and inflation was low. So bonds had the biggest return they'll ever have and probably never have again. And so I call that the bond bubble. It's a 40-year bubble. But, so bonds have these long periods of high and low returns, but stocks are just much more steady as a long-term thing. And that's why they're the best long-term investment for your long-term money. First, they said that the highest long-term return of all the asset classes, because you're investing in big companies, but also because they are steadier, they are lower risk over time. So what you see when you look at the market, most people think of it in a short period of time, 1 month or even one year. And if you look at the stock market returns 1 year, year by year, you see they're up and down a lot. 3/4 of the years are up, but you see it looks pretty unpredictable in a short term. But you go to 25-year periods, and you realize it's always been a good gain. In fact, the modern stock market started around 1930, that's when they got past just agricultural stocks, and they got into manufacturing and finance and industrials and much more different kinds of companies. And so from then until now, so the last 90 years, the worst 25-year stock return of the stock market is the S&P 500, is about 8% a year. It's actually 7.9, but 8% a year. And that's the worst return. Like the average has been around 10. And you see that basically any 25-year period, the market is between 7 and 17 times higher. So by learning these few things, you can just learn to have a higher risk tolerance. So now myth number 5 is you are smart money. So quote unquote smart money. Now there's a lot, you see articles sometimes about smart money and dumb money. And in the industry, the perception is the industry players, the big investment firms are the smart money, and the regular everyday people are the dumb money. In reality, when I look at how they invest, I don't really see much difference in smartness and dumbness, because both of them will sell at the bottom and buy at the top. So they do kind of the same thing. But that's kind of the same thing. And what you sometimes see, for example, is the average regular people, most of the trading is right at the beginning and right at the end of the day. That's why, because they're doing stuff at night and they're working all day. And the smart money, the big investors are kind of investing all the way through the year. So all the way through the day. So you often see there'll be a surge one way or the other right at the opening of the stock market, and then it'll kind of trend one way, trend the other way. So they'll say, oh, that was the dumb money selling off and the smart money coming in later on. So, but I'm not really getting into all that. So what I really find is the reason I'm raising this is because the biggest weakness that many people have in investing is their own ego, thinking they're smart. And once you think you're smart and think you're a good investor, that's when you tend to make the most mistakes. So I see that especially with a lot of guys that tend to get really overconfident in whatever their system is, whatever their method is. And that is often their biggest mistake. So, and overconfidence can make you think, oh, I can time markets, I can pick stocks, I can, you can invest all well. But what I find sometimes is it's so when I see somebody who says, okay, I can time market, they tell me about a time when they sold out and the market went down, and and they avoided the decline. What I find that it really what it is they weren't able to tolerate a decline, so they've had to sell. So it's it's like staying invested over the long term is what the market goes up long term, and getting all of that gain is the secret to growing it. If you're trying to time the market and get it out, you're going to miss big parts of that gain. And most likely, I found the vast majority of people who try to time the markets make less long term not more. So in fact, I knew two guys before the 2008 was a big crash, two guys that before that, they thought there was going to be a crash or a big market decline, so they sold entirely to cash. The market went down 40%. So, and both of them, I lost touch with them, but I talked to them about 3 years later and to see what they were doing. And in both cases, they were predicting another market decline, and they were still in cash. So the market had fully recovered and was up, and they were still in cash. So they actually had a lower rate of return, even though they were right. They had a lower rate of return. And you see that with a lot of people will tell stories about how they did well, but really, how did they really do over time? Now, one of the really interesting things that I've been to a lot of, financial planning conferences from the, financial planning investment industry, and get to talk to a lot of other advisors, and most of them are guys. And the interesting thing is, in most cases, they look after their accounts and their wife's accounts. And the wife doesn't even get involved. They look after both accounts. And when I asked them this question, like basically every one of them, their wife's account has done better than them. Now you think, why does that make sense? Because he makes all choices for both. And yet the wife's account always does better than their own account. And the reason is because they'll always give you the same reason. They took some gamble on something. Basically, in their own account, they did more stupid things. In their wife's account, they bought more of the solid, steady stuff, and they did more dumb stuff in their own account. So that's kind of the main reason. Now, there's a whole field of study called behavioral finance. There's a whole bunch of books on it, and really, in the short, it's all about how your ego hurts you. And investing, it's a really a major factor. So, and now in the end, you're right if your facts are right, but you're not right just because you believe you're right. So, one of the books that I really love that's actually full of debunking market risks is a Ken Fisher book called Three Questions That Count. He actually has a sequel that's Three Questions that's the only three questions that still count. But he always talks about the stock market being the great humiliator. Like just when you think you're doing something well, it kind of humiliates you. And it's being able to, what makes you a successful investor is humility, like realizing that I have my weaknesses. Let's just try to understand this, and let's invest as we think is in a good quality long-term investments. And then you think of, let's say I'm wrong. If I'm wrong, how am I most likely to be wrong? Maybe I should do a bit of something that's elsewhere. But it's having that humility that I find is what makes a good investor. When I meet top fund managers that are really cocky, that's usually kind of a turnoff for me. That to me is, if they're too cocky, that probably means they're not necessarily all-stars. They're just, they could speak confidently, but it seems like the more you know, the more you realize what you don't know. So, now, myth number 6. Asset allocation is effective investing. Now, you hear asset allocation everywhere. All the advisors and banks all tell you should have stocks and bonds and cash and be within your risk tolerance. And there's a problem with that. There's several problems with it. It's just actually not effective investment. So now doing this reduces your short-term volatility, but doesn't reduce your long-term volatility. So now what we find is, when you look at the world long-term, a lot of things are just much more clear than if you look short-term. Okay, so I'll give you an example. So short-term, like stocks and bonds, and you should allocate and move between them, and maybe I have a bit more stocks now, a bit more bonds at the time, and all this stuff. But then long-term, you think, what? Over the long term, stocks are up 8. Let's say conservatively 8%. Bonds maybe make 5, cash makes 2, and over the long term, that's basically what it is: 8s, 5s, 2s. Now, if you have a portfolio and you're thinking long term, it comes down to how many 8s and 5s and 2s do you want in your rate of return, and that's really what it comes down to. So you can forget about, like, being 100% equities is what's going to give you a higher rate of return long term. If you have a portion in stocks and bonds and cash, much of the time, you're almost for sure that have a lower long term rate of return, and probably not lower volatility. And in fact, so when you look at a 200-year study, of stocks and bonds, so that rated by standard deviation. Now, standard deviation is the measure of risk. So really, it's really a measure of uncertainty. Okay, take standard deviation after inflation, and you see a visual picture of it. You see stocks are actually quite a bit more risky for 1 and 2 and 5 year periods. But when you get to 20 and 30 year periods, stocks are actually have a lower standard deviation after inflation than bonds and cash. So they're actually more predictable than bonds and cash long term. So short term, stocks are definitely riskier and more unpredictable than bonds and cash. However, long term, they're actually more predictable and lower risk. So if assuming you could stay into them, if you're truly a long-term investor, bonds or stocks are actually the lower risk of the investments. And that's why it's having all stocks can actually be both the safest and the most reliable way to get, and the way to get a much higher rate of return long term. And that's why they're the best investments. Stocks are the best investment for your long-term money, for your retirement. So I've even had an article on the risk of bonds in your retirement, and I declared the death of bonds. Remember this big tombstone with Elijah Jefferson Bond, who, funnily enough, is the patentee of the Ouija board, right? So to me, I was kind of my joke, right? So that bonds kind of had us believing they worked for a while, but once you see it through it, they don't really work. So just like the Ouija board. Now, from a financial planning perspective, I see another really big problem with asset allocation, and that is you cannot retire comfortably with a balanced portfolio. Like you go to see an advisor, they give you a risk tolerance questionnaire, you come out as a moderate investor, therefore they're going to give you a balanced portfolio of 60% stocks, 40% bond or something, and basically they have eliminated your chance of retiring comfortably, because basically nobody can retire comfortably with a balanced portfolio. Half stocks, half bonds. You need a much higher amount of stocks over a long term if you want to retire comfortably. And I've had this in a few different videos that I've done before, but so you need I've done well over 1,000 comprehensive financial plans, and when you look at them, so you just look at the rate of return that you need to make, and if you do a financial plan with a 5% rate of return, which is maybe what you get on a balanced portfolio long term, what you find is basically nobody can make it to the goal that they want. So you need 7 or 8% or at least as a long term rate of return in order to have to be able to retire comfortably over the long term. 8%, that's kind of the worst the stock market has done in 25-year periods of time. So that's, if you're 100% stocks well invested, that may be a reasonable, somewhat conservative number to have in your rate of return. But if you're a balanced portfolio at 5%, it's just not going to work. So, and even after you retire, like most people think that, once you're retired and you're older, you have to be more conservative. But, when you're 65, you probably have 25, 30 years in front of you, still qualifies as long-term. And it's doing all these financial plans that has given me this just completely different and real vision. So if you look at a plan, so let's say you're investing for 40 years from age 25 to 65, and then you're retired for 30 years from 65 to 95. So it's a 70-year period of time. Now, over that period of time, the income that you're living off for the 30 years of retirement, between 70 and 88% of all that income is growth after you retire. So you have 30% or less of your retirement cash flow is money that you have when you retire. Most of it is money you have later on. That's why even older people need to maintain that growth mindset and stay focused. So now I've done a bunch of charts. I'm not going to mention them. I'm going to go through them a bit quickly here, but they're just about examples of retirement plans, and it's just to show you that you can't retire comfortably with asset allocation, with a balanced portfolio. So here's a case of a single person, age 35, making $50,000 a year, wants to retire at 65 on $40,000 a year. All right. So to do that, 50,000 retiring at 40,000. With a balanced portfolio, they need 1,150,000, and they actually have to invest 17,000 a year, which is 34% of your gross income. So if making 50, you have to invest 17,000 of it. So now if you make 8%, then you only need 775,000. You only have to invest 6,500, which is 13% of your gross income. That's much more reasonable than 34%. So now, same person, it's a couple, both make 50,000, so 100,000 total. They want to retire on 80,000. That's 40,000 each. With 5% rate of return, again, they have to invest 34,000, 34% of their before tax income. That's ridiculous. So, but with an equity portfolio and all its stocks making 8%, you only have to put in 13% of your income. So it's not even maxing out your RSP, and to make it. If you're all in stocks, but it's a ridiculous amount. If you don't, if it's all in if it's a balanced portfolio, you've got to do about double the amount of RSP room that you get. So now with middle, let's take more middle income. So you take 100,000, a couple that's married. Okay, single person making 100,000 wants to retire on 75,000 30 years later. They have to invest 50% of their gross income. So you make 100,000 before tax, you have to invest 50,000 before tax to be able to retire on 75,000 before tax eventually. Nuts. Nobody can do it. But again, if you make 8%, you only have to invest 20% of your income. So that, which is basically maxing your RSP and slightly more. So a couple that make 100,000 each, so 200,000 together, they want to retire on 75,000 each. That's 150,000 in total 30 years from now. They need to invest, again, 50% of their gross income with 5% rate of return, 20% of their gross income with 8% rate of return. So, all right, so you notice that every time the 5% number is nuts and the 8% number is reasonable. It's not easy, but reasonable. So let's take a high income person. So a person or a couple making 500,000. Let's say they want to retire on 300,000. That's only 60% of their income. 30 years later, they want to retire on 300,000. They need to invest 53% of their income. So you make 500,000 before tax, you have to invest 265,000 a year. That's nuts, because if you're making 500,000, a lot of it is going in tax. So, but you have to invest 53% of your gross income at 5%, but only 21% of your gross income if it's at 8%. So so it doesn't matter if you're single, married, low income, medium income, or high income. It's the same thing. You got to invest between 30 and 55% of your gross income to make it with a 5% rate of return. And yet with an 8% rate of return, it's between 13 and 20% of your income. It's just not easy, but an easily doable amount. So bottom line is, you cannot retire comfortably with a balanced portfolio, period. So but if you're 100% equities, basically, if you maximize your RSP and put a bit in TFSA, in most cases you're basically there, and that's not easy, but it's a doable amount. So that's the problem with asset allocation, is you've just wiped out your chances of retiring comfortably. Now you can still retire, but not comfortably. You find people who don't plan properly, invest conservatively all their life. When they're retired, they're living off the government benefits and they have modest amount of income, but they're home much of the time, don't travel much, not much entertainment, so and that's what you can afford if you're invested with asset allocation and a balanced portfolio. That's all you get. Now, myth number 7: you can reduce your risk and volatility without reducing your returns. So, and there's many versions of this, and there's the odd exception, but basically, anything that reduces your risk, like your short-term volatility, probably reduces your return. I've seen a few professional investors that are making exceptions to this, but in most cases, that's the general rule, and it works. And one of the arguments for investing with less volatility is you can sleep at night. But there is no evidence. I love this quote. There's no evidence that people who sleep at night are good investors. So. Now, let me give you, so many different variations of this lower volatility, lower risk. So one of them, again, is asset allocation, having stocks, bonds, and cash. It's all about having, having lower short-term fluctuation is really what that's all about. But because a good portion of your money is in low return investments, bonds and cash over most of the time, or all the time, you're almost definitely gonna have a significantly lower rate of return. Probably 5 instead of 8 or 10 is a long-term rate of return. And again, that's what kills your retirement. So now market timing. So people who try to time the market, what happens, let's say they sell out, they go to cash when they think the market's going down, and they go invest again. First of all, they're wrong most of the time. And even when they're right, you have to, if you get out, you have to get back in at a lower price for it to be worthwhile for you. And bottom line is, over a 30-year period, they're in cash quite a bit of the time, and that's what brings down their return. So another funny one I like is people that buy individual stocks often put stop losses on their stocks. So stop loss means if it falls by more than a certain amount, they're automatically going to sell. And that always struck me as odd. So if you have an investment and you will sell it only because it's gone down, to me, that makes no sense. You probably shouldn't have had that. You don't have no confidence in that investment. You shouldn't have it in the first place. So I get stop losses. I call them take loss options. It's like, how much of a loss do you want to take? Very often they're set 10% or 20% below the current price. So if my stock falls by 10%, I automatically sell it without looking at it. And so to show you, this is a logic error. It's just it's a brain fart. So just think of it. Let's say you have a house worth $1 million and you were going on vacation. So you told your real estate agent and your lawyer, if you get an offer of $900,000 or less, immediately sell it without even calling me and just sell it. You think, well, that's obviously stupid. Why would I sell it lower? But that's really what these, stop loss, or as I call them, take loss options are. They're meant to sell. If your stock falls a lot, it sells. It'll sell automatically before plunging further. But if you have a good company and it falls, most likely you should buy more, not sell it when it's down. So another popular one in the last number of years is called low volatility. Low volatility stocks. So there's even ETFs that are low volatility that just fluctuate less. And you know what? And also dividends. The other one is dividend stocks. Dividend investing has been a very common thing. Dividends investing is 100% equities, but you're gonna have lower fluctuation because you have slower growing established companies that pay high dividends that tend to lower your volatility. But in both cases, with low volatility and with dividend stocks, you're missing out on some of the growth stocks. You're missing out on a chunk of the market that is growing a lot, and therefore you should probably make it a bit lower rate of return. So the lesson here is, if it makes you feel safer, it reduces your long-term lifestyle. So now, myth number 8: stock market returns are random. This is an interesting one because there was a classic book called A Random Walk Down Wall Street a few decades ago, and it led to this entire random walk theory. And the theory is that since everybody knows everything about the stock market, about the values of the stocks, future movements in the stock market are all going to be based on news that comes out, and you can't tell what the next piece of news is, so therefore it's all random. And stock market is just random, and that's often used as a reason why, number one, you should just buy index funds, and number two, nobody can beat the market because it's just random. How could skilled investors do better? That's kind of the argument. Now, in this classic book here, Stocks for the Long Run, by Jeremy Siegel. First of all, I think this is the single best investment book ever. So if you want to read one book, it just covers so many topics, so in depth. It's amazing. You read that one book, and then you're already knowledgeable about investing. But he basically proved that this entire random walk theory is false. So the actual fact is, the risk of stocks falls about twice as fast as the random walk predicts. So the random walk predicts that stocks would fall, the fluctuation of stocks over long periods of time would be lower than over short periods of time. But in reality, it falls much faster than you'd predict. But bonds and cash, the risk falls much slower than you predict. So I actually have charts of this, and so on the chart it shows the risk level of first of all, if you look at stocks, you see 1, 2, 3, 5, or down to 30 years. And on the chart, there's a dotted line, which is the random walk, what the random walk hypothesis would say. Okay, and what you see is the actual risk, once you get to 10, 20, 30 years, is quite a lot lower. It's basically half of what you'd think it would be. Meanwhile, bonds and especially cash, once you get to 20 and 30 years, you realize the actual volatility is actually more than double what you'd expect based on this random theory. So the random walk theory is false. Now, it takes a little bit to understand exactly what this is. So let me just kind of try to explain in concept what this random walk is. So you may have heard the term a reversion to the mean. That's again a term most people misunderstand. So let's say you take a dice. Dice, you can dice between 1 and 6. Now, totally random is you dice. You could get any one of those numbers. Now, a lot of people think reversion to the mean is if I'm dicing a bunch of 6s, well, I must dice a bunch of low numbers after that, and that's actually not what it is. It's just that if you dice, let's say you dice a bunch of 6s, but then you dice 1,000 times after that, well, you're going to get all numbers, and the average of all those numbers is probably going to be quite a bit lower than 6. So that's why it kind of reverts, and that's what the random walk says: is that you just randomly dice, and even if you have a high return over time, it'll probably go back to the long-term average. So now, what actually happens with stocks is if you dice a bunch of 6s in a row, if you dice a 6, you're probably going to dice a 1 next. And same thing, you dice a 1, you're probably going to dice a 6 next. So with stocks, the biggest gains are right beside the biggest losses, right? Usually right after. So, and that doesn't matter if you're taking minutes, hours, days, weeks, months, years, or multiple year periods. The biggest gains are right beside the biggest losses, and they usually reverse it. So that's this reversion to the mean with stocks is far more than random would suggest, because they bounce back. In other words, when they go down, stocks bounce back much more than you would expect based on random. Now, bonds and cash are the opposite. So they would be, if you're dicing a bunch of 1s, you're more likely to keep dicing 1s, and that's what happens with bonds and cash. They tend to have long periods where they do well, and then long periods where they do badly, and so it's called aversion to the mean. It's the opposite of reversion to the mean. They tend to get the risk over time falls much more than it falls much less than what you'd actually expect. So now this point of the largest gains in history being beside the largest losses. I'll just give you one example. So when was the biggest bull market in history, the biggest period of time, let's say a 4-year period, the biggest gain ever was in the middle of the Great Depression, 1933 to 36. The market was up 196%, so it tripled in 4 years. So now that was right after the biggest loss in history was 1929 to 32. Take calendar years, it was down 63%. 1929 to 32, that was the biggest loss ever. 1933 to 36 was the biggest gain ever, right after it. Right? And that's the normal. The biggest gains and losses are always right beside each other. Now, the funny thing is, one thing that you may see from advisors quite often is this chart. If you miss the 10 best days, then you would get a far lower long-term rate of return. And actually, the sentiment makes sense. The sentiment is you should stay invested long-term, because if you try to time the market and you miss the 10 best days, then you're going to get a much lower rate of return. And I've had people argue, well, what if I'm a good market timer, so what if I just miss the 10 worst days? And the problem is both of those don't really make sense, because if you miss the 10 best days, you probably also miss the 10 worst days, because they're probably right beside each other. I think the very next day, right? So it's almost impossible to miss both extremes. So now the whole thing about the random walk, when I've heard the theory, to me is it just from the beginning, I just thought, what, it can't be true, because it says that nobody can beat the market, and yet we've been investing with these all-star fund managers, sort of long-term track records, beating the market after fees. And you know what? I know a bunch of guys that do, and every one of them has a different way that they're beating the market, their own systematic weakness in the market that they can beat. And so, and they're all, it's always a different way. It's always something unique, something really, really cool about this one manager. But there are people that beat the market long term. So the fact that there are has to mean that the random walk theory is wrong. And now it's been actually proven to be false. So myth number 9, crypto or day trading is effective investing. Now, I don't usually talk about crypto at all, but you know what? I see so many, especially younger people, putting all their money into it, and it just worries me because, because it could go nowhere. And so I had a video out of a couple months ago about gambling. And I put crypto and day trading and basically in the same category as lottery tickets. It's just gambling, and to me that's something. If you want to put your fun money in there, that's where you put your fun money in, and assume that you're going to lose it. And like crypto, the thing about crypto is it had a big run, and now nobody knows where it's going. And the problem is there is no intrinsic value to it. So who knows what it could go? It could go to 1 million. It could go to 0. And the fact is, I don't see any market for whatever it is, 3,000 different cryptocurrencies out there. I don't see any scenario where they all survive. The big thing in 100 years ago was cars coming out, and they were just a massive big thing that everybody got into. And at one point there were like 200 car companies, and yet in the end we're down to about 5 or 6. And I think that's what'll happen. Like almost all the cryptocurrencies will disappear. They don't really have a way to merge, so it's got to be that most of them go to 0, and there isn't intrinsic value. So when I talk to people that believe in crypto, they always give you arguments about why it should exist, but nobody has an argument about what it should be worth. So I say, okay, let's just say let's say Bitcoin should exist, but I think it should be worth $1. It's at 30,000 now. Well, it should be worth $1. Prove to me that it shouldn't be worth $1, and there isn't a proof. There's no intrinsic value for it. So. And so, we're financial planners. We help people make smart decisions over the long term. And, over the long term, to live the way you want, retire comfortably, you need a good long-term rate of return. And I have no idea. I know exactly what stocks are, quite relatively precisely what stocks are going to do over the long term. I have no idea what crypto will do. I've had people ask me to write a financial plan based on crypto, and I thought, what? I have no idea what rate of return to put on this. Minus 100. Like, I don't know what rate of return to put on this. I can't write a plan with just crypto investing. It's so, and it's to me it's gambling. It's kind of it's like a tax on ignorance. It's really what it is, because you're investing in something you don't know, and it's it's therefore you can lose a lot of money. And so lotteries are actually the same thing. I saw one study once said 30% of people, probably not really true, but saying 30% of people actually believe that winning the lottery is part of their retirement plan. They're going to buy one every single week, and therefore they're likely to win eventually. The truth is, it's not true at all. So, if you took the actual odds, if you buy a ticket every single week for 40 years, and somebody else, your buddy, buys one ticket once, and you calculate the odds, his odds are almost exactly the same as yours. By buying one ticket a week for 40 years, you've hardly increased your chance. Almost no chance that you're ever going to win. So it's the kind of the math of it. It's just all gambling. So now day trading is kind of interesting. It was much more common 20 years ago, and it's mostly died off. But I've seen people that are very actively trading during the day, or something. They quit their job and they're watching stocks trade. They're trading. They're very actively trading, trying to look for a short uptrend and then sell off, and this really active trading. And sometimes on the day when they make quite a bit, day when they lose quite a bit. So, but when you compare this to high frequency trading is the same kind of thing, but done effectively for the most part. But when you see them, you see why day trading can't work. Okay, and so I had a client a number of years ago who was a high frequency trader, and so he worked for this high frequency trading company, and he was coming to us to invest his retirement money. And I said, like, you work for this, like, why don't you do the same thing in your RSP? Like, and how does it work? So, and he says, well, here's what it is. He says, our typical investment, our average investment is 10 million, and our average hold period is 3 minutes. I thought, all right, good. You can't do that with your RSP. Obviously can't do that with your RSP. So that makes sense. Um, but now, so when you understand how it is, you talk to a lot of professional investors, you get to see what's actually happening here. Now, high frequency traders get a lot of bad press, and some of it's warranted, but some of it's actually like mostly it's good what they do. A lot of what they do is keep the market efficient. So you notice that often the same stock is available in several different exchanges, right? You can have a stock that's available on the New York Stock Exchange and the NASDAQ, also the TSX. So it's on the same stocks in several different exchanges. You see the price is basically exactly the same all the time. Why does it always stay that way? And it's because these high frequency traders, they'll just notice, you know what, if I can buy a stock and then immediately sell it for a 1/10 of a cent higher on a different exchange, then I just made that money. And they just make the trade, right? So that's what they tend to do it. So they make the market efficient. They do a lot of good that way. So, however, a lot of this high frequency trading is really it's called front running the large investment firms. I call it like leeching off of them. So just think of it. One of the big mutual fund companies or pension companies or ETFs is whatever is they're trying to buy a company, buy a new stock, and try to build up they want to buy a big position in it. And if you're a $5 or $10 billion fund, you want to put 5% of your company in there. So it's a large amount of that stock you have to buy. So you plan to buy it over a little period of time. And so what these high frequency traders are is they're very sophisticated, fast computers, and they're trying to detect when there's a push up on one stock that's pushing it up. Okay, so and that's basically what they want to do is they want to basically buy it and then immediately sell it to that big company that's doing it, and they just make their small little profit in between. So what means is the big company is getting it, they're paying just that slightly a little bit more of it, because the high frequency trader leached off of them, got the little bit lower price. So that's a lot of what's happening. So much of the high frequency trader, some of it's keeping the market efficiency, looking for the same stock in different places that are not valued the same, or stocks that convert to each other. But part of it is a big part of it is looking when you see a trend and this trying to make, you buy them and immediately sell it back for just a small fraction ahead to the big company that's buying it, and you make that little bit. So now what actually happens here is really interesting. So do you know that more than 99.9% of all trades on the stock market are canceled in the same second? Now that's a frightening stat. So you put a price on to buy a share, you immediately cancel it, and that's what happens on almost every single trade in the stock market. Is canceled immediately. You think, how does that make any sense? What's that? Now there's a term for it. It's called pinging. So here's what happens. So a big investment firm wants to buy a stock, and so what they do, they'll begin buying it, but then high frequency trader is trying to detect when it's going up, right? They're trying to detect the upward trend so they can leech off a little bit, right? So what the big firm will do is they'll put a buy on it and sell it, and then see if they can sucker the high frequency trader into buying it. Oops, and nobody could buy it, and they lost money on it. Right, so it becomes a technology war of who is the faster trader, and there's a story about 10 years ago, and people didn't understand it except until you understand how this high frequency trading works. So it was a company called Spread Networks. They laid a 1,330 kilometer fiber optic cable all the way from Chicago to New Jersey, and through the mountains, they laid this 1,300 meter fiber optic cable. And the reason is it reduced their trading time. Like they're connecting their office in Chicago to the stock exchange in New York, and it reduced their trading time by 15 milliseconds. That's 15,000th of a second is how fast it reduced it. But that's all the difference in the world. They're trying to outguess each other, right? So I can do some buys, whatever, and I can put a whole bunch of fake ones out there and try to fake out the high frequency trader. And so that's what's all happening here. These this massive update in trading, and the high frequency traders literally they have thousands and thousands of trades per second and cancel. It's all done by computers. So And that's what the high frequency trading is. Now, I'm just giving you that example. Now you get a sense of what that is. Now let's go back to the day trader. You know, one guy sitting in his house coat, sitting at home, trying to trade, and he'll look at a chart, and then he'll buy a company and he'll try to sell it a few hours later, and you realize he's just not even in the game. Like he's you know, the high frequency trade in the time between when the day trader buys and sells a stock, the high frequency trader literally has done 1 million trades. Like the day traders aren't even in the game, and if they're detecting something, it's, you know, it's who knows what. There's a big game going on between the big guys and the high frequency traders, and you know, it's so whatever they detect could be for whatever reason, and they may miss it. So the bottom, to me, day trading is, it's not, I've seen a few people actually quit their job, and in every case, 6 months or a year later, they're back at work because they thought they could make money day trading and they didn't, and they couldn't. So I put all these crypto and lottery and day trading and these things that are like, when you're trying to invest for the long term, you need things that are reliably going to make money long term. And you know, the big flaw with day trading is the stock market is up, you know, 100% of 25-year periods. However, if you take 1 minute periods, it's only up 50% of them. So if you're in and out, in and out, and out, it's a 50-50 game. But if you're a long-term investor, it's very reliable for long-term rate of return. So it's that long-term thinking that and looking for long-term growth. That's the kind of investments that you need to be able to have the future you want. Myth number 10, real estate returns are as high as stocks. So we've had a good run in real estate the last decade. So it's a lot of people believe this, especially people in, you know, a couple of the big cities like Vancouver and Toronto. But it's actually not true at all. And so I've got the actual stats since 1975. The average house price in Toronto was 75,000 in 1975. Now it's, you know, around 1 million. So, however, if you have the same amount in the Toronto stock market, you would have almost 5 million. In US stocks, you have about 10 million, and global stocks about 7. So, you know, so the growth of the Toronto stock market the last 45 years is 5 or 6 times the growth of Toronto real estate. And that period of time was the best ever in history for Toronto real estate, and about average for the Toronto stock market. So its stock market is just a way higher long-term rate of return. All right, so so there isn't any comparison there at all. It's just way higher as a long-term rate of return. So, and now even with risk, you know, people tend to think a house is really safe, and you know, most years the house just slowly goes up, and stocks you see them fluctuate. The problem is stocks you see second by second or day by day price fluctuations. You don't see that with your house. You're not getting offers on your house every day. If you got people putting offers on your house every day, you kind of see what it looks like. You get some weird ones now and then. But if you actually look at, you know, so the biggest drop in a year, from top to bottom, from 1950 till now, the biggest drop in Toronto real estate prices in the last 70 years was, from top to bottom, was 28%, and the stock market was 43%. So you do the math, real estate actually has 2/3 of the downside risk of the stock market. So, and what's more is it tends to fall, it takes much longer to come back. So the 28% decline in real estate was, you know, back in the 90s. So it fell for 4 years in a row, and 5 out of 6, and then took 9 more years to recover. So altogether, 13 years from top to bottom and back up again to even. For the Toronto stock market, the longest ever been a 6, 2 years down, 4 years to recover. That's the longest it's taken. So 6 years and you're back even. So versus 13 for real estate. So it's 2/3 of the real estate is, you know, a small fraction of the long-term growth and 2/3 of the risk of the stock market. So now, I'm not saying real estate's a bad investment. Like owning your home is still a good thing to do, because you want to live somewhere, anywhere it's tax-free. And actually, so the real beauty of real estate is that you leverage it. So you put 20% or down on your home, or 25% if it's a rental property. And what you're doing is you're leveraging 4 to 1. And that is basically pretty well the main or the entire reason why real estate can be a good investment. So For example, I'll people say to me that, comparing stock market to a real estate buying a rental property. So I have $1 million. Should I buy a rental property or should I buy the stock market? Well, over time, your stock market's going to do way better. Almost for sure it's going to have a way higher growth. But what if we're going to get a mortgage on it? So let's say I'm only got 250,000 and I'm going to put it down on a $1 million rental property versus 250,000 in the stock market. So you're now comparing $1 million of real estate with 250,000 of stock market. Well, you know what? Quite likely, if you get a decent property and positive cash flow and stuff, your property may well do better than the stock market because it's 4-to-1 leverage, and that's the entire secret. So now the truth is, you can do the same thing with the stock market. A lot of people wouldn't be comfortable with it, but somehow in reality, it's hardly any more risky. But let's say that you put 250,000 down on $1 million property, versus you put 250,000 down and you get a 3-for-1 loan on $1 million in the stock market. Now again, you owe 750,000, and you're comparing $1 million rental property versus $1 million in the stock market. Well, over the long term, again, the stock market is probably going to do way better. So that's the difference. So the whole thing about real estate needs to be leveraged. Real estate, to be a good investment, needs to be leveraged. If it's not leveraged, the rate of return is low. So I have, Ed's rental property rule of thumb. So is when the mortgage on a rental property, when the mortgage is down to 50% of the value of the rental property, you should sell it. And then invest in the stock market, you get higher returns, lower tax, and no work. So once you buy a rental property, once the value, the mortgage is down to 50% of the value of the property, just sell it and invest something else. So, what some people do is they keep pulling the equity out and investing in more, which is another way to do it. What we've done with a few clients is you keep using that extra. So we do the Smith maneuver strategy, where you're borrowing your available equity, works beautifully on rental properties because you kind of keep them at 75%, 80% leverage all the time. There's part of it is the mortgage to buy rental property, and part is the money that you borrowed to invest in the stock market with the Smith maneuver. So therefore, you're keeping it highly leveraged all the time, and that can be, doing a Smith maneuver on a rental property is what can make the rental property a really good investment as well. All right, so this is what you learned. We went through these 10 money myths that block your financial freedom. Wealthy people have nice cars, homes, and vacations. Now we know better. The economy helps you predict the stock market. It's the other way around. The risk is your investments going down. No, risk is achieving your long-term life goals. Your risk tolerance is part of who you are. Nope, it's a learned skill. You are smart money. Well, no, because your ego is what gets you into trouble. Asset allocation is effective investing. No, in fact, if you invest that way, you have no chance of retiring comfortably. You can reduce the risk of volatility of your investments without reducing your returns. No, basically anything that reduces short-term volatility reduces your long-term returns. Stock market returns are random. Nope, it's proven false. There are people that beat the market long-term. Crypto and day trading are effective. No, they're not. There's no intrinsic value, and so there's no way to know that you're making a good rate of return long term. And real estate returns are as high as stocks. No, they're actually a small fraction of the return over the long term, but you can make them better by leveraging up. So, all right. So thanks a lot for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. And it's at www.edrempel.com. And if you are interested in talking to us, just go to contact on the blog and ask for a free 30-minute consultation. And we're not trying to sell anything at all. We have a conversation with one of our financial planners and see whether or not we're fit to work together. Also, I have a YouTube channel. I'm about to launch a podcast. So please like and subscribe to the blog and my YouTube channel. And all that means is when I try to do a new video or article or podcast every week. And if you subscribe, then you'll get all the new ones usually every Thursday directly to your mailbox. So thanks again for listening, and we'll see you next week.